I want to do today then really is kind of get right into my topic, and we're going to keep moving our day forward because we've got 16 companies plus 3 newsletter writers who all want to get their say in before everybody goes home at 4 o'clock. So I'm going to start right in with mine. And so I'm going to talk about the energy markets here a little bit about, obviously that's my specialty, and just trying to give everybody a little bit better handle on where life is a bit better than you think and where life is a bit worse than you think. Just because what we see in the media has a certain relevance to what's going on, but they don't cover everything, and they don't cover everything in my point of view from the right point of view. So I'll go through a couple of quick topics here. And the first thing I want to tell you is that it's way better than you think on the fundamental side in the energy markets. Much better. Like if you were to read all the papers and believe everything you read, you'd think we've got this huge glut of crude, which is only partially right. Like we run about every year, supply and demand both increase by about 1 million barrels a day per year. And that has been so steady for so long, literally almost 40 years. But certainly for the last 10 to 15 years, supply's gone up by about 1 to 1.1 million barrels a day, and demand's gone up by about the same. In fact, supply's probably gone up by a little bit less than that. So despite all the oil price trials and tribulations and the gyrations, you would never believe that the fundamentals of the oil market are what they are, because supply and demand are 2 very steady straight lines, each going up by about 1 million barrels a day a year. And when you look at the oil price, that's not really connected. It's pretty startling to think of the differences and variations in the oil price that we've seen, given how steady and constant supply and demand are. So even last year, the forecast was for just under 1 million barrels a day increase in demand and supply. Supply was up about 1.35 million barrels a day last year, but pretty steady. And even this year, last fall, all of a sudden all these new forecasts came out saying, oh, we're only going to be up about 600,000, demand is only going to be up about 600,000 barrels a day a year to around 93.5 million barrels a day. But even since then, the lower oil price has increased demand so much that they've already upped that. It's even more than that now. Demand is forecast, this is about a month old now, but 2015 forecast is now about 1 to 1.1 million barrels a day increase in demand. So there really is no shortage of demand. Everywhere around the world, we're seeing some big increases. And I'm going to go through some of that with you, why the media is really kind of missing the story here. We have a very Western-centric media, so they focus on North America and Europe, and you hear Jeff Rubin talking constantly about how demand destruction and peak demand in North America, but that's just nothing compared to what the rest of the world is experiencing. So you look at the Middle East, they've gone from under 6 to just over 8 million barrels a day in the last 10 years, and of course China's been the big story, from just under 6 to almost 11 million barrels a day, very steadily over the last few years. And obviously everyone talks about their rate of decline, their growth rate declining, but growth is still growth. And every year when you're growing at 10% a year, it doesn't take very long where all of a sudden 2 and 3% growth is the same what 5 and 7% growth was 6, 7 years ago. And here in North America, as you can see, yes, we've got less demand than we did before, but marginally so. Not even 1 million barrels a day less. When you look back at what the Middle East and China has created moving forward, what we've done here, our drop in demand is just a drop in the bucket. Same with Europe. And this is where all the media is concentrated that we listen to. And that's why, Chicken Little in the sky is falling when they read these types of media statistics without doing the real work to figure out where we are in some of the other areas of the world. So like I say, Africa and Middle East is now basically the same as Europe in terms of global demand. So that has been a big up-and-comer. You don't read about that very much in the media. And Asia has overtaken North America in terms of demand. So what we're really seeing here is we've got quite a multipolar market for oil now. It used to just be the States. The States is 25% of the world's economy. Everybody focused on that. But it really is now a situation where demand around the world is much stronger and much more even. As I said, the numbers are actually very straightforward. 1 million barrels a day, both supply and demand for the last 10 years. But of course, in the last couple of years, what we've seen is that the shale revolution has really taken hold. And that's been for a couple of reasons. So we've basically doubled our pace of growth for the last 3 years. And 80% of that growth from around the world is from the USA, and that's the shale revolution. That's all the tight oil in the North Dakota Bakken and Texas that's really making a big impact. Now, Where is the market worse than we might think? Well, the energy market, particularly in the States, doesn't make any money. And people find that hard to believe given what the stock price is doing. But when you study the financials of these companies, it's very clear that they don't even make money at $100 oil. And the main reason for that is that the debt markets are very easy. They're able to get a lot of very, very cheap debt that can hide the money that they're losing. And what people don't understand is that even the most oil-based companies, like we think about the North Dakota Bakken, and they think, oh yeah, that's an oil play. And it is. It's the granddaddy oil play in North America. It's the biggest new discovery. But even a company like Continental Resources, the big player there, they're 30% gas. So we think of like the Canadian Bakken is actually much oilier because it's shallower. But down in the States, where all the production is coming from, there's still a lot of gas coming out of there. And in fact, they're well over 1 billion cubic feet a day of associated gas with all their oil production. So that's really what's the big secret here that people don't seem to be understanding. So my colleague Nathan Weiss at Unit Economics in Boston, he did this study last fall on these financials, and basically showed that even at $60 WTI and $3.85 gas, you know, the top 33 independent producers are losing $12.5 billion a quarter, $50 billion a year of hard cash going out the door. And the only way they can really get to free cash flow is to stop growing completely or have oil prices go to about $103 a barrel. So when you think of how the debt situation has really created this shale revolution to keep going for so long when no one's making money, that's what the Saudis, when they decided on Thanksgiving Day in the States last year, they said, okay, enough is enough. We are not going to be the guys who cut back on production. That's just going to, in the end game, end up slitting our own throat. We're going to let this find a market-based economy. People had all kinds of geopolitical ideas. Okay, they're after the Russians. They're after the Iranians. They want to break the back of their enemies in Iran and take Russia down with them. And it's all Obama working with the Saudis. I think that's probably a great aftershock effect, but I don't think it was the real thing. I think the real target that these people were after, the Saudis, is the shale lenders, the banking community in the United States that has just gone crazy in giving these shale producers money completely willy-nilly, working on marginal plays, and everyone thought that the Saudis were going to be there to backstop the oil price so they could do this. And that's when the Saudis said, okay, well, if we take away the debt, if we can convince the shale lenders to stop funding these plays that don't make any money, that's why they keep saying it's the high-cost producers that should be cutting back, not us. We're the low-cost producers. And they're right. So it's interesting how we're looking at one of the most authoritarian regimes who've done way more beheadings than ISIS, is introducing market discipline to a bunch of right-wing Alberta and Texas entrepreneurs. And really, what's interesting now is when I wrote this a month ago saying, you know, right now there's a lot of interesting talks with lenders where the producers are having a situation where they could have their bank lines reduced. That's actually not even happening. Like, basically, banks are now waiving all kinds of covenants in the States right now to keep these shale players alive, and because technically a lot of them should be very close to insolvency. They should be getting their lines pulled back, but it's not happening. The banks are just waiving the covenants because the last thing the banks really want is the keys to the farm on an oil and gas company. So they're working quite closely with the industry to make sure that it keeps going. It just doesn't keep going at quite the same breakneck speed that we've seen for the last 3 years. So again, just to put the numbers in very stark, plain sight, in Q3 2014, when oil was $97 a barrel, the average cost for a shale producer was $55 a barrel. But the average revenue was only $46 a barrel. So what the producers like to say is, oh yeah, our cost is 55 bucks a barrel, and look at WTI, it's 97 bucks. But the reality is that they're not telling you what the revenue is, and because there's so much gas, associated gas with their production. Again, that's not really quite the same as it is in Canada, where you actually have quite oily companies, like in the Viking play, like in Saskatchewan Bakken. But in the States, it's really gassy, and that's why you really are seeing such a big decline in cash flow to the point where there's no free cash flow in the U.S. energy industry at all. And it's stunning to see what the stock prices have done despite all this. And that's, again, because we've had such great cheap debt available to them. So just a quick couple things on that gas. I tell everybody, look, watch the tide, not the waves. And the production is the tide, and weather is the waves. what we've seen here in the last few years, if you look at this chart, so the blue line is what storage is doing, and the red line is what price is doing. And what we saw here in about when the shale revolution really took hold in gas, a few years earlier than it did in oil, the price of gas just basically stopped moving with storage. It used to be very tightly tied, like for 10, 15 years, really since time began. But in 2010, the hard cap of production just increasing constantly has stopped the price of gas from moving. Gas price has been very, very steady. You can see there was a small blip down in 2012 when gas hit a low of about $1.40 in Canada and $2 in the States. And this chart ended here last year, but that's what we're seeing now. Again, that red line has actually dipped a little bit because we're seeing, again, quite low gas prices in the States and Canada right now, and probably will continue for this calendar year. So again, the price of nat gas is not responding to inventory changes anymore because they just see that hard cap. And this is just exactly what's happening right now. The fact that natural gas demand is up 5 billion cubic feet a day in the States, that's not being recognized. The polar vortex 2 that we're seeing this year on the East Coast is not being recognized in the gas price. In fact, the gas price is now 30% lower today than what it was when withdrawal season started late November. I don't know that I've ever seen that. And so, again, it's because of the incessant production increases out of the States, and that can be summed up in one word: Marcellus, the big formation in Pennsylvania, New York, West Virginia. You look at that nat gas growth rate, and it has been pretty remarkable, and it's still going higher. Last year, we were up about 7 or 8 billion cubic feet a day. We're up another 7 to 8 billion cubic feet a day in production so far this year. So it's pretty impressive what's been able to happen. So from a Canadian point of view, this has been really difficult for our producers. And that's why I was really wanted to have Chinook here, because Daryl and Walter, they got lots of net cash, and there's going to be a lot of pain on the streets this year for domestic gas producers. And the guys that have a lot of net cash are going to be the winners. So I see gas in Canada this year trading $1, maybe even less than that. I think it's going to go no bid for some of the weekends in the States in Canada this summer. So it's going to get really tough. And the guys that have the balance sheets are really going to be able, I think, to come out of this thing much better than those that have debt, and almost all of them have lots of debt. So again, just to kind of go over what I said earlier, nat gas has all been about the Marcellus. And what I tell people is that generally we don't need to worry too much about natural gas prices until the Marcellus peaks. So when we see the Marcellus production numbers coming out flat for 3 months in a row, then we can get long gas. Until then, you got to be very, very selective and pick the right management teams and the guys that have lots of money. When the Marcellus does peak, a rising tide is going to lift all boats, and we can get long anything, and we're going to make money. But until then, we're going to have to be very, very selective. And Canadian production out of the Montney, in particular, Canada has lost about 1 billion cubic feet a day of production every year for the last 5 years. We've gone from 18 to 13 billion cubic feet a day. Now we're actually going back up again because of all the production out of the Montney. So that's even one more negative on the Canadian side. And then really what the toughest thing for us Canadians right now is that the Marcellus has got a lot of new pipelines coming out. So they're taking over basically the Eastern Canadian market and the Northeast US market that we used to fill quite a bit. So our gas is now being pushed back, and we're seeing that this isn't something that's going to happen later this year. This is happening right now. Like in the last 3 to 4 weeks, we are definitely losing market share to the United States. Much cheaper Marcellus gas. Gas in the Marcellus trades for about $1.50 right now, $1.30, compared to Canadian gas at $2.50, $2.20. So this is already happening, and we're being backed out. And if it wasn't for California really increasing their imports of Canadian gas, we'd be even lower than we are right now. So it really is incumbent on the producers, the pipeline companies, and the governments to work together to put together some kind of area of financial regulation that is going to work to help keep Canadian gas competitive in the North American marketplace, because right now we are in a real risk of being squeezed out of except a couple markets. So basically, I think for the next 4 to 5 months this calendar year for sure, that's going to spell a lot of bad news for Western Canadian economy. You're already hearing the media reports of that, where everyone's talking about recession potential in Alberta, layoffs, Calgary housing prices, taking a downturn. So that is going to have a big ripple effect throughout Western Canada. So that's where we're really going to have to hope that the LNG game gets going and can pick up a lot of slack in that. Because really, we've heard a lot of talk about the oil price collapse, but honestly, Alberta and Western Canada is probably more gas dependent on the economy than oil. So it really is something that as gas prices fall down here to lower levels after the spring breakup, that we're going to see some potentially even worse situations in Western Canada. So despite all the negative news we've heard about oil is actually going to be the bright spot this year, I think. I see oil finding a level probably around $65 a barrel in the States before things really get going. NatGas, however, is going to keep falling. And so that's going to be, really for investors, what's that going to mean is we're going to have to be very patient. You only want to buy the leaders, the best management teams, the guys that have actually quite high valuations. We don't want to own cheap stocks in this market. You want to pay, if we're going to make any bets in the junior market these days, you want to buy the leaders, the guys with great balance sheets, and the guys that can finance. And those stocks are actually quite expensive. So we don't want to own cheap stocks because they are going to stay cheap. The expensive stocks will stay expensive. Really, I think the finance industry is going to be in hard times because, like I say, the junk bond market in the States, depending on which statistic you read, 17 to 33% of all junk bond debt in the U.S. is energy. So that's going to have a bit of a ripple effect across the financial markets as well. So I think that's it. I think I might even be 2 minutes ahead of schedule. And thanks very much for listening.